This is a good year, which really shocks people. I find that certainly on the West Coast, people are angry at this bull market, mostly because somebody keeps taking credit for it. But beyond that, you're looking at a low right at, remember, Christmas Eve last year was a real big drop in the market. So I look long term, like you know. So for me, 2019 was a great year, but it averages out as part of this long-term bull market. I don't think we have a recession near term as much as people think. I think next year we'll have 2% GDP, so we should have a reasonable equity market. Maybe not double digit. We're overextended, but at least a positive returning type year.
I think the average return over, 100 years is something like, what, 7 or 8% annualized, maybe throwing a little bit more for dividends. That sounds about what you expect, Chris.
It is, exactly. We actually start from the 1860s and come forward. And when you look at that time period, you're going to average around 7 with that dividend income being a good chunk of it now. So.
Yeah, that's why your money tends to, I think it's what, every 8 or 9 years, you double your money in the equity market at historical returns. Well, it's good to hear that. It's good to hear even some return because, to your point, I don't know about being angry, but there are people that are worried. They say, the market has come too far too fast. Everybody's piled into too few stocks at the very top. So you don't see much risk of a major or even just a minor equity market decline next year.
Well, Brian, I see risk everywhere, that's for sure. But you're right. I think we're due for, a good 5% correction anytime in here. The market, the PE ratio isn't at extreme levels. Earnings are at least still coming in strong, although sometimes they're disappointing. But look at the last quarter, you had at least over half of the were positive reports. So I think you're going to still see some compaction for companies and challenges, but generally positive earnings, which yields a positive market. It will be choppy. This is going to be another election year. Remember 2016? That was a really hard year where the market really slugged it out to try and generate a positive return. We may have that kind of year because of all the rhetoric we're going to hear.
It's been a weird year in a way that we haven't had very many pullbacks at all. Do you think, Chris, that's because last December we had this major market swoon of 15%, the worst December since 1931? Did we sort of take all the healthy correction and put it into a very unhealthy 3-week period?
Well, we sure might have. I have to say that correction surprised me. Christmas Eve, frankly, shocked me. I still think the machines were involved there,
of course,
without question, and the lack of traders around. So I am surprised, actually, at last year that we had very few, at least weeks of lower returns with all the global trade problems that we've had and the difficulties we've faced. But it's back to that base corporate earnings. That's what matters. If corporate earnings are doing okay, the U.S. consumer is somewhat optimistic. And look at the jobs reports during the year. Just constantly good news on jobs. And I think that helped fuel this market.
But I actually want to ask about something else. It's a little bit wonky, and I know you're in New York. Is there anybody that you're talking to, or maybe in your own mind, a little more worried about this issue in the repo market in New York City than maybe is being made of?
I've seen it before. As you know, I've been in the business a long time. I've seen that year-end compression. And interestingly, it happened many, many years ago where we had that strange compression in September that caused repo rates to blow out. But the answer is yes. I am talking to people about it. We run over $3 billion in short-term cash. So we're worried about it at CalSTRS. Our trade desk is one of the groups I meet with regularly to talk to about the fluidity of that equity, the liquidity market. I think John Williams and the New York Fed are going to get a handle on this. There are fewer banks in the market providing that liquidity, which is a concern. But the world is awash. And so I think that this year we might have a few blips, but the Fed's going to come in and provide liquidity, keep that repo rate in line. That really is almost like the blood pressure. As long as that's within a very good range and healthy, the cash system, and that's what I think, it is wonky, but a consumer needs to know that if the repo rate is fluctuating wildly, it means that the basic cash level in the system is having challenges. And we had a couple of days.
That's why I mentioned it. I mean, it is WBI, wonky, but important because it's kind of the bloodstream in some ways, the most basic level. So it doesn't sound like you or people you're talking to believe that this could be endemic or sort of systemic of a bigger issue or the spark that could, set off a bigger sell-off.
I think that September was kind of a gotcha. It surprised everybody because you had 3 different events come within a week of each other. A lot of people have been planning for this year end and buying cash alternatives that take them over year end or provide them liquidity at year end. So I think people are going to manage this cash period well, and it will be fine. I do not believe it will lead to a problem in the equity market.